Okay, we're gonna work, this is chapter 21, so we're gonna work, not chapter 21, problem 20. Problem 21-1A from chapter 21. It is on page 1085 of your book. It pertains to what's on slides 8 through 38 and pages 1050 to 1060 in your book. So we're looking at two different income statements here. We're going to do an absorption costing income statement and then a variable costing income statement with the same information. So it tells us during the first month of operations ended August 31st, Kodiak Refrigeration Company manufactured 80,000 mini refrigerators, which 72,000 was sold. So they manufactured 80,000, sold 72,000. Operating for the data for the month are summarized as follows. So we have all the sales, the manufacturing cost, and then the selling and admin expenses. So the first thing it does is ask us to prepare an absorption costing income statement. Now this is basically the income statement you've been preparing before, where all costs are included. So we start out, so this is part one. We'll start out with our title, Kodiak Refrigeration Company. I'm going to label it absorption costing income statement. For the month ended August 31st. It doesn't give us any kind of year, so we're not going to worry about that. We start out, of course, with sales, which it tells us our sales were $10,800,000. Gives us that information. And then our next section is going to be our cost of goods sold. So to get cost of goods sold, remember it tells us it's the first month of operations, so we don't have any beginning inventory. We know that. So we have our cost of goods manufactured. Which is, it gives us, and here we can take the total. We include all cost, variable and fixed, of our manufacturing cost. So we take the 9.6 million it gives us. Then we have to subtract out our ending inventory to get our cost of goods sold. So our inventory on August 31st. So to do that, we have to figure out first, and we know we have 8,000 units in inventory. Remember, we manufactured 80 and sold 72,000. So that's where the 8,000 comes from. And then we have to find our per unit cost for the 8,000. So to get that, we're going to take our 9,600,000, divide it by the 80,000 units that they produced. And that's going to give us a per unit cost of $120. So 8,000 times $120, we end up with our ending inventory of 960,000, which of course we're going to subtract from our cost of goods manufactured. So then our total cost of goods sold $8,640,000, which of course we subtract from sales to get our gross profit. So we end up with a gross profit of $2,160,000. Then we have selling and admin, which just puts all on one line all together here. $1,260,000, which which we're going to subtract from our gross profit. And then we have operating income of $900,000. All right, and then the next thing, part 2, same information, but this time we're doing a variable costing income statement. Try to start a little bit higher, a little bit longer. So we still have Kodiak Refrigeration Company. This time, variable costing income statement. And once again, for them both ended August 31st. All right. We start out the same way, of course, still an income statement, so we're still going to start with sales. Our sales are exactly the same, whether you're doing variable or absorption. Then, instead of cost of goods sold here, we have what we call variable cost of goods sold. So in variable costing, remember, our fixed overhead, our fixed manufacturing cost is treated like a period cost. So we are not going to include that here. We're not going to include that in our cost of goods manufactured. So instead of where it says cost of goods manufactured in the absorption, here we have variable cost of goods manufactured. So to get our variable cost of goods manufactured, if you look at the problem where it says manufacturing costs, you include your direct materials, which is $6.4 million. You include your direct labor, which is $1.6 million. You include your variable manufacturing cost, which is $1,280,000. You do not include the fixed manufacturing cost of $320,000. So we end up with variable cost of goods manufactured, $9,280,000. And then once again, we have to subtract out our ending inventory to get our cost of goods sold. So inventory, August 31st, we're gonna have a different ending inventory amount because we have a different cost of goods manufactured amount. So we have to get our per unit cost again. So we have the $9,280,000 divided by the 80,000 units we produced, which is going to give us $116 per unit for our cost. And we still have 8,000 units left. That's not going to change. We still made 80, sold 72, so we still have 8,000 left. So our 8,000 times the $116, we have $928,000 in our ending inventory. So then we have total variable cost of goods sold. $8,352,000 for that, which of course we're going to subtract from our sales. In variable costing, you don't report a gross profit. What you report here instead is what we call a manufacturing margin. $10,800,000 minus the $8,352,000, we have $2,448,000. Then we have variable selling and admin. So remember, over here, all of our selling and admin were in one line. Here we only want the variable portion, and it separates them for you in the book. So we just take the $1,080,000. We're going to subtract that from our manufacturing margin. And this is going to be, at this point, all of our variable cost will be out, and and that's called our contribution margin. So we have 1,368,000 for our contribution margin, and then we start subtracting our fixed cost. So we have fixed manufacturing cost, which are $320,000. And we also have our fixed selling and admin cost. Which is 180,000. So our total fixed cost $500,000, which we're going to subtract from our contribution margin to get our operating income, which is $868,000. So you'll notice this is lower than this, and the reason why it's $32,000 lower, the $900,000 minus the $868,000. It lies in the fixed cost here. You can tell there's a fixed cost of $4 per unit, the difference between the 120 and the 116. You could also take the 320,000 that it gave us for fixed manufacturing cost and divide that by 80,000. So there's $4 of fixed cost that's in inventory here, that's not here. Remember, we had 8,000 units in inventory times the $4 per unit fixed cost. Takes us back to that $32,000 difference. So what happened is, here all the fixed costs came out. Here, that $32,000 is still in this inventory, and it'll come out when we sell it. All right, that's it for chapter 21. Let me know if you have any questions, problems. See you later, hopefully.